Are you looking for the number one best financial strategy to get the most financial control? Maybe you're weighing velocity banking versus infinite banking. You're trying to figure out what are the differences and which one should I use. Now, both of these concepts are something that sound very similar, but there's key differences that you really need to understand in order to be able to make this decision to the best of your ability. Now, velocity banking is a strategy of being able to pay down your liabilities or your debts as quickly as possible. Proponents of this strategy will use a line of credit or a HELOC to be able to pay down a mortgage as quickly as possible. Some say within 5 to 7 years, some closer to maybe the 10-year mark, but it's used as a strategy to cut down repayment times on debt and be able to save interest. Now, usually what's happening inside of a velocity banking strategy is you have a home equity line of credit that you are paying down instead of a mortgage. And this strategy of funding the HELOC and then being able to use the HELOC as your cash banking account is what you then use to pay off your liabilities. The major perk of what's happening inside of the velocity banking strategy is that you're paying off debt sooner, which seems like I'm saving interest and maximizing my control, and I'm putting equity into the property that I own so that I have this equity pool to be able to draw from, essentially for emergencies and opportunities. Now that can sound very similar to infinite banking. Let me share with you what infinite banking is, just in case you're not familiar. Infinite banking is a strategy of using a specially designed whole life insurance policy or contract that is with a mutual company that pays dividends to earn high cash value. Now, this is not just any old life insurance policy. This is a policy specifically designed to pay in your premiums, and then you have a death benefit. You also have a growing cash value that's as high as possible in the early years and continues to grow. So similarly, both of them use the word banking. They're both ideas of being able to recede from or separate from the typical banking institution where the bank is in control of your cash and instead take over the banking function for yourself. Both strategies say that they are about maximizing your control, but really, what's happening behind the scenes? I want to give you a side-by-side comparison between what's actually happening in the velocity banking strategy versus the infinite banking strategy so that you can make decisions for yourself. In reviewing this video, there's a few things I forgot to mention that I think will bring a lot of additional clarity to you. The first is that we are not anti-HELOC. In fact, we've even helped clients to be able to implement using a HELOC specifically for investing purposes. However, we are not proponents of paying off your house as fast as possible because there are so many things that cause you to lose control when you do that. The first thing to compare is what's happening with my extra cash. Now, if I have, say, $5,000 worth of income each month and $3,000 worth of expenses, my gap or cash flow is $2,000 per month. What am I doing with that extra cash? Well, in the velocity banking strategy, you are putting that extra cash into your HELOC or your line of credit. And essentially what's happening is you have this line of credit that you're putting all of your cash each month and your cash flow, your surplus. So if you had a balance of $100,000 and you're putting $5,000 in that month, then your balance goes down to $95,000 from $100,000. And what's happening is that you're building that buffer of equity. Then you pay all of your bills out of that account. And so the balance on your home equity line goes up again as you pay out your expenses. It drops down again as you then put in your income again. So where are you putting your extra cash? In the velocity banking strategy, you're putting it into the home equity via the HELOC itself. In the infinite banking strategy, or privatized banking, which is another word for the same infinite banking strategy, where's your cash going? Your cash is going to premiums on a life insurance policy. That money that you have put in premiums then is showing back up for you in the cash value component, meaning that you have access to your cash that you've put into the policy. Now, with infinite banking, you do have a drag on your accessibility and your liquidity in the early years because there are some costs of the policy. And sometimes that can be a huge deterrent to somebody because they say, I funded $5,000 into this policy. I have access to maybe $4,000 or $4,500 in the first year. That cost or that lack of liquidity is due to the internal cost of the policy. However, when you look longer term, you'll see that you have a tremendous internal growth rate in cash value life insurance on the infinite banking side, which I'll come back to in just a minute. Now let's look at why you would do this strategy. The velocity banking strategy, what's the main appeal or why you would do this? The number one reason is to pay off debt as quickly as possible and to save interest. Meanwhile, you're building equity that you can essentially use and tap into. With the infinite banking strategy, the number one reason to use this strategy is that A, you're building a death benefit, which is something that you can pass on to your children and leave a legacy. You also are building up cash value, which is a store of cash or savings. It's a true savings asset that you can use for emergencies and opportunities. Next question, where is the balance of my cash? With velocity banking, my balance is in home equity. With cash value life insurance, where is my cash? The balance is in cash value or the cash value of the life insurance policy. Now let's talk about liquidity. How liquid is the equity in velocity banking versus the cash value in my life insurance policy? Let's look at velocity banking first. How liquid and accessible is that cash? Well, theoretically or hypothetically speaking, if you have a line of credit and that limit is $100,000, you should be able to have access to $100,000. However, you do not always have access to the full 100,000 if you're in a position where somehow that line of credit is frozen or locked or reduced. If you look historically, back in 2008, many lines of credit were locked or frozen or reduced, and we have personal experience of people who have had that exact situation happen where they thought they had $100,000 of available line of credit, and all of a sudden, that was tremendously reduced, in one case down to $36,000, because there's a clause within HELOCs that the bank can change the terms if you're facing a job change or job loss or income loss, or if your house value is significantly reduced, as in 2008. So you should have liquidity inside of a HELOC as long as your terms are not suspended or frozen or reduced. The other challenge is that within a HELOC, there's two different portions or chunks of time. The first portion is called the draw period, and after that you have a repayment period. The draw period, now that could be 5, 10, 15 years. The most common is 10. If you have a 10-year draw period on a 30-year HELOC, the first 10 years are the draw period where you can access and take your money out of the equity. This is actually done with a debit-like card, and so you can very easily take money directly out of that HELOC. However, as soon as the HELOC converts into the repayment period, you no longer have that accessibility. Now the equity is locked and your terms increase so that you are now repaying principal and interest. Whereas before, during the draw period, you only were paying an interest-only payment or only required to pay an interest-only payment. You certainly can always pay more than the minimum. Now, as we're talking about the liquidity of the velocity banking strategy, it's supposed to be liquid, but that's questionable. It's not a guarantee that it will be liquid for you. Let's jump over to the infinite banking strategy. How liquid and accessible is cash value? Well, there are contractual guarantees inside of a life insurance policy that you are able to access your cash value. Now, what does this mean? You actually can access your cash value in multiple ways. One is through withdrawals, and you can take out your cash value. You can also access your cash value with a policy loan. And that is as simple as making a loan request to the company, which they're contractually required to provide you cash up to the available cash value inside of your policy. What does that actually mean? That means your cash continues growing and you're leveraging your cash value by using the insurance company's money. That means your money continues growing even while you're using it. And that comes into play in just a moment, as we'll talk about another comparison between velocity banking and infinite banking. Next, let's look at, does my cash earn a return? Now, if we look at velocity banking, your cash is going into home equity, and that is through the home equity line of credit. A home equity line of credit can never earn a return. So even while your cash is being stored in the equity of the house, the home equity line cannot earn a return, and also the equity inside your house is not earning a return. Now, this probably sounds a little confusing because most people think their home is a great investment and that it's earning a return for them. That's only true if you sell your house and the house has appreciated in value. However, Appreciation is completely independent of equity. Regardless of how much you have a loan outstanding on your house or not, two properties can appreciate at the same rate, and it has no discrimination based on whether you have a loan outstanding or whether you have your house completely paid off. Now, if we look at earning a return inside of a life insurance policy, the answer is yes, indeed. Your cash value does earn a rate of return. So just how much is that rate of return? Well, when we look at a cash value life insurance policy and we look at your cash value, it grows every year by guaranteed interest with an after-tax growth rate. And it's uninterrupted compound interest, meaning you're getting that very nice exponential compound growth curve even while you use your money, because you can borrow against it and keep your money growing. On top of the guaranteed interest, you also earn dividends, which are not guaranteed, but are highly anticipated. And the reason is that the companies we work with that we've seen have been paying dividends for over 100 years, even through the Great Depression. So what does all of that mean? When you boil it down, even in today's low dividend rate environment, you can expect a 3 to 5% after-tax internal rate of return on your life insurance cash value based on interest and dividends. Now, what that means is that you are continuing to earn interest even when you use your cash, meaning you are offsetting the cost of capital because you are being the bank and truly earning, not just paying interest. If we look at the safety between velocity banking and infinite banking, velocity banking, your equity is not safe because it can drop in value. With infinite banking, you have safety because your cash value cannot drop in value. So what does all of this mean? If we're looking for the strategy with the maximum control, where I am in the driver's seat of my financial life, where I have confidence and security for the future, and I know the future value that I will have, and I know that I can access and use my money, and I don't have to have the bank's permission, and no one can close down my terms of authorization to get my cash, that's the maximum control. And now, after we've compared line by line velocity banking versus infinite banking, I would say head and shoulders, infinite banking puts you in a position of control. And that is because you have safety, you have liquidity, that you can access your cash value, and that is growing at a higher, faster, compounded rate. With velocity banking, I'm still not in control because the bank has the authority to trump my access to capital. I hope you've enjoyed this comparison between velocity banking and infinite banking. I invite your questions, and the reason is that I know this is a topic that really is on many people's minds because you want to be in as much control as possible, and you want to use your resources to the best of your ability to maximize your control. And my goal is absolutely to help you make the most informed, best financial decisions possible.